Hello and welcome to the lecture on accounting. So I'm going to try to be fairly brief in this lecture because what I teach most often is accounting, so I can talk and talk and talk about this subject, and I don't want to make an hour-long video for you to watch, so I'll try to keep this fairly truncated. If you have taken Accounting 201, 202, or 203, you probably will know much of what I'm going to be talking about here, so it'll be a review for you. If you haven't, it gives you kind of a little taste of what you're going to talk about in those kinds of classes. So I'll talk first about the role of accounting, what accounting is. I'll talk a little bit about what types of accountants there are in the business. I'll talk about the accounting cycle. I'll briefly overview a set of financial statements, and I'll talk about ratio analysis, so how you analyze financial statements. So what is accounting? If we were talking together in person, I would tell you that accounting is a form of storytelling. It's a way of telling people what happened in a business over a given period of time. If you owned a small business, say you owned a fleet of food trucks, and that's your business, what you're going to want to know at the end of a month, at the end of a quarter, at the end of a year is how are we doing? Are we losing money? Are we making money? How are we going to, what's the future look like? Are we going to be okay? Are we going to make it? Do I have enough money to pay myself a bonus, or do I have to lay people off? All of those kinds of questions you get from the story that accountants tell about what happened with the business. I would argue that the closer you are to telling a true story of what really happened in the business, the better that result you'll get from the decisions that you make based on that information. So that information is both for people outside the company and inside the company to make informed decisions. I'll talk about that in a minute. All types of organizations require accounting. So not just businesses trying to make a profit, but government entities have to do accounting, not-for-profits have to do accounting, South Puget Sound Community College has to do accounting. So different types of users, of course, people that own the company have an interest in how the company is doing, so they can decide, should I invest more? Should I sell my investment? Should I be involved in this or not? Creditors have an interest. They want to know one thing: am I going to get paid back? And those financial statements can help indicate to them if they think they're going to get paid back or not, what the chances are. The management of company needs very detailed financial statements because they need to know the profitability of every product. They need to know which parts of the company are being more productive. What is their return on marketing dollars? What about investments in new technology? Will it benefit them in terms of productivity? All of those kinds of things are how they plan and control the company as it moves forward, and they need accounting information to be able to make those decisions. Employees and union officials need accounting records because they need to know what they can legitimately require in contract negotiations. So it doesn't do any good to require significant raises if that kills the company. Lenders and suppliers need to know it because it's based on, again, being able to get paid back. And then, of course, the government needs to know so that they can tax you and get their share. So accounting looks at a variety of different business activities, and one way you can kind of organize those activities is in these three groups, and you'll see this later when we show the statement of cash flows. One is financing activities. That's the act of going out and borrowing money that you need to bring into the company. It's the act of raising money by selling shares of stock to new owners in the company. That is financing activities, along with paying down debt and rewarding shareholders. Investing activities, that's where we take money and we invest it in new machinery, in new technology, in a bigger building, in another location. All of those kinds of things are investing. And then we sell some of those things to generate money potentially. And then operating activities, I'd say that's the most important category because that's the gist of what you do for business, why your business exists, whether it's selling food from food trucks or if it's making tables and chairs or whatever the business is, do the operations of that business, how do they perform? So different kinds of jobs in accounting. When people say accountant, a lot of times people think of CPAs, which are public accountants. CPA stands for Certified Public Accountant. I have my CPA license, although I never worked for any real degree of time as a public accountant. Public accountants work for accounting firms, and they generally engage in three different kinds of activities. One is auditing. Auditing is an outside independent accountant that comes in and looks at your books and gives them credibility. Issues a letter that says, I've looked at this and it all appears correct to me. So it gives legitimacy to the internal documents that a company produces, because a company has an interest in making themselves look better. So they might fudge the numbers a bit, make things look better than they really are. So to protect investors and creditors, most companies have an outside auditor that comes in that gives, again, credibility to their information. Of course, public accountants are engaged in tax preparation and tax planning for individuals and for companies. And then they also do management consulting, help companies reorganize, help them put in accounting systems, things like that. Managerial accountants, that's what I did for the first half of my career, are generally work as cost accountants. So companies need to know what everything they make costs. If you work for a hospital, you need to know what it costs to x-ray a broken arm, all of that. If you make a product, you need to know what that product costs. So that's a cost accountant. There are internal auditors, there are tax accountants inside companies, and then there's one I didn't list here is a controller. That's somebody that oversees all of the accounting function and makes sure it's being done properly and manages that function. And then there are government and not-for-profit accountants that specialize in the rules associated with those kinds of entities where they're not trying to make net income. So accounting standards, there are rules that accountants follow so that there is consistency between companies and consistency over time within the same company. Those rules are called generally accepted accounting standards. So that determines how transactions are recorded and reported in an accounting system. The generally accepted accounting standards are created by the Financial Accounting Standards Board. They've been given that responsibility by the Securities and Exchange Commission, which is a branch of the federal government that overviews publicly traded companies. You may have heard about the Sarbanes-Oxley law. That's a law that was passed after the Enron collapse that requires more transparency and more independence in the financial reporting for publicly traded companies, more of a focus on internal controls within the companies. There are also international accounting standards, but I won't get into that in this lecture. So the accounting cycle, the first step is to identify business transactions. We made a sale, we purchased supplies, we paid one of our employees, whatever the case is. We record those transactions, so we capture the transactions, record them in an accounting system, and then those general journal entries are posted to ledgers. So then we get what are all the things that happened with advertising? What are all the transactions that happen with sales? All the transactions with supply expense, so forth. So we get totals by different categories. We create a trial balance, which is a listing of all the accounts. Based on that, we look that over, make sure that that's correct, make corrections if we need to. Then we prepare financial statements, and then we analyze those. So the fundamental equation that drives all accounting is this accounting equation. So on one side of the equal sign, you have assets. That's what the company owns. So the company owns their building, they own computers and furniture and machinery and those kinds of things. They might own things that aren't tangible, like patents and copyrights and trademarks, things like that. Those are all the things the company owns. On the other side of the equal sign are all the liabilities. That's what they owe other people. So they might owe taxes to the government, they may owe their suppliers, they might owe their employees for the last pay period, their pay, all of that. And then whatever is left over is the owner's equity, the owner's stake in the company. Now, every transaction is going to impact different elements of that equation, but the equation will always stay in balance after every transaction. That's critical. So a little bit about financial statements. The balance sheet shows the financial position of the company. It basically shows that accounting equation I just mentioned. What are all the assets in the company? What are the liabilities? And what is the owner's claim to the business? The income statement shows if the company made a profit or not. Did they make net income and profit are synonymous with each other? So did they make net income? So that is going to be sales or revenue. Those words are synonymous, minus expenses. Statement of owner's equity shows changes in the position of the owner's interest in the company. So it's going to also include, did the owners put more money into the business or did they take money out? That sort of thing. So it basically is a reconciliation. It's what was their beginning balance, what increased it, and net income and investments can increase it. What decreased it, decreases are caused by losses and the owners taking money out, and that gives us the ending balance. So that gives another part of the picture or part of the story of what happened in the business. And then lastly, statement of cash flow shows where cash came in from and where cash went out to. So here's an example of a balance sheet. You see it starts with current assets. Those are assets that are going to be used up or turned into cash within a year. So those are kind of short-term type assets. And then we have longer-term assets, property, plant, and equipment. Of course, that's buildings, equipment, machinery, computers, all of that. And then that third category, goodwill and other intangible assets, that's what I mentioned before. Those are assets that are worth something and are real, but you can't physically see them. So the other side of the balance sheet then is liabilities and stockholders' equity. So current liabilities, those are liabilities that have to be paid within the upcoming year. And then long-term liabilities, long-term debt like a mortgage on the building or something that's for many years. And then stockholders' equity. So those two, you can see total assets there for this current year, 8,790, and that equals total liabilities and owner's equity. That's the balance. They have to equal each other. The income statement starts with sales. We subtract cost of goods sold. If it's a manufacturing company, that's the cost of the products they're selling. And that gives us gross profit. That's how much is left over when we subtract the cost of a product from what we charged a customer for it. That, of course, needs to be positive. Then we have operating expenses. Some people call that overhead. So the rent on the building, the president's salary, advertising, the utility bills, all of that kind of stuff are operating expenses. That gives us an operating profit. And then we subtract depreciation, which is the cost of assets that we spread over the life of the asset, interest, and that sort of thing. So we have earnings before taxes, then we have our income taxes to the federal government. This is for a corporation, and that gives us net income or bottom line profit. So a statement of owner's equity looks like this. As I mentioned, it's kind of a recap. So it's what did it start out at? We add net income, we subtract cash dividends, which is money paid out to the owners. We repurchase some shares, so we subtract that, and that gives us ending owner's equity. Then lastly, a statement of cash flows. That is those three categories I mentioned earlier: operating activities, investing activities, and financing activities. So this company determined that their operating activities, the core purpose for which they're in business, generated 1,682. Actually, I think this is in thousands. So 1,682,000 in cash. That is the most important number on this statement of cash flows. If that is negative, that's unsustainable. A company can't continue with the core purpose of their business requiring to be fed with cash, because the only way you can create that cash is by borrowing it or getting money by selling stuff, selling assets. And there's a limit to those two activities. You can't do that forever. So eventually that number for operations has to be positive. This company here had some capital expenditures, so they spent money on investing activities. And then their financing activities were negative as well because they paid out money to the owners and they repurchased shares. They could have also paid down debt, which would have made it negative as well. And then that reconciles the beginning and ending balances of cash. So a little bit about analyzing financial statements. So one way to do it is a horizontal analysis. This is very common. That's where you're showing multiple time periods next to each other and comparing one time period to another. So an example here, their sales were 1,530,500,000 in 2014. In 2013, 1,234,000. So we take the 2014 figure minus the 2013 figure and then divide that amount by the base year, which is 2013, what we're comparing to. That shows that sales went up 24%. Okay. The benefit here is we can look down that list of percentages and we can start to get some meaning here. So example, if sales go up 24%, but I look down here and I see that my selling expenses about midway down went up 29.9%. That means my cost of selling the product, which is probably salesperson commissions, is increasing faster than my sales are increasing. That's a negative trend. Eventually that will cause me a problem. So I would look at this and I would say that needs to be explored a little further, because I need to know if that's an anomaly, a one-time problem, or if that's a trend that's going to continue that requires some action from me as a manager of the company. Common size analysis is where you show all of the elements of a financial statement as a percentage of one of the numbers. So in this case, these two companies determined that net sales would be their 100%, and all of the other figures are a percentage of the net sales figure. This allows you to compare two different businesses that are of different sizes. It can be difficult if I own one restaurant and I compare my financial statements to somebody that owns 10 restaurants. It can be a little bit difficult just looking at dollar figures to compare those two businesses. When you put them like this in percentage terms, then you can start to see, what does rent as an expense of overall revenue, how does that track, and how does that compare with this other business I'm comparing myself to? Again, this is a way of kind of uncovering areas that might be a problem. I have a reference here for you to a site called bizstats.com, great website that has this kind of information for just about every type of business you can think of. So if you have an uncle that owns a bar and he says, my bar isn't making very much money, you can go to that website and you can get something that looks just like this, income statement by percentage. You can convert his income statement to percentages and compare the two and potentially find out where the problem might be. There are also ratios that we can calculate by comparing different items on financial statements. A very common one is the current ratio. These both are liquidity ratios, which is an indication of how easily a company can pay their bills as they come due. So if I was granting credit to another business, they were saying, I'd like to buy $10,000 of product from you and we'll pay you in 30 days. So I'm having to trust them that they'll really pay me. I might look at their financial statements and calculate this ratio. So I take the current assets on the balance sheet, divide by the current liabilities, and that will give me a number. Okay. The higher the number, the better. The more likely it is that they'll be able to easily pay me when the bill comes due. A rule of thumb is you want this to be at least 2.0 or higher. Okay, you want the current assets to be at least double what the current liabilities are. A more severe measure of this is taking current assets and subtracting inventory. So looking at just cash and receivables compared to current liabilities, because if all of your current assets are inventory, well, to turn that into cash, you have to first sell it and then collect the money from the sale. So asset test ratio would be a lower number, but maybe a more accurate indication of if you're going to get paid. A couple of really good activity ratios to keep in mind are the number of days sales and receivables. That's how old is your average receivable. That's where you billed somebody, they owe you money, they haven't paid you yet. Okay. A lot of times businesses can say, gosh, we're profitable, our sales are increasing, but we never have enough money to pay our bills. We're struggling with cash all the time. The reason for that is generally one of these two areas has gotten out of control. Either people aren't paying you on time or you're buying too much inventory and holding it on the shelf. So both of these ratios can tell you if you have a problem and where it might be to fix that problem. So as an example, number of days sales in receivables, I'll divide average accounts receivable by average daily sales and I'll get a number. Say I get a number that's 38, okay? That means that the average receivable in my collection of receivables is 38 days from the day I invoiced. That's how old it is. Now, if my terms are net 30, it means that people aren't paying me in 30 days. So I could fix that by having more stringent credit requirements, by hiring somebody to call everybody on the 29th day. There's different things I could do to make that better. The same thing with inventory. I could take average inventory, divide by average daily cost of goods sold. That'll give me a number. It'll tell me the number of days the average item in my warehouse has been sitting on a shelf. If I accumulate too much inventory, that's inventory I have to pay for, but I haven't received the money from my customers for it yet. So it's like money on the shelf. So again, I can see what the direction of that is. Then lastly, profitability ratios. So I mentioned gross profit margin. That's really important. Looking at gross profit divided by sales, that's really important for retailers and manufacturers. Net profit margin, of course, is net income divided by sales. That's a good way to compare companies. And then lastly, return on equity, net income divided by average equity in the company. That means if I give this company $1,000, how much are they likely to turn that into more? That would give me an indication of that. So thank you for your attention. I look forward to talking to you in the next lecture.